So, before we even talk about whether it can make you rich, we need to understand what dollar cost averaging, or DCA, actually is. In simple terms, dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, no matter the price of the asset. For example, let's say you want to invest $500 every month in a stock or mutual fund. Whether the price of that asset is high or low, you stick to that fixed amount. Over time, this means you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost. Cut to visuals showing an example of DCA in action. Here's a visual. If the stock price is $100 in 1 month, you get 5 shares. If it drops to $50 the next month, you get 10 shares. This consistent approach can lower the average price you pay for the investment over time. So why do people love dollar cost averaging? One major reason is that it removes the emotion from investing. Let's face it, timing the market can be tricky, and most of us can't predict where the stock market is going next. DCA takes away that pressure. You're not trying to buy at the perfect moment. Instead, you're spreading your risk over time and buying in all market conditions. This strategy is especially appealing for long-term investors who are focused on steady growth rather than quick gains. Cut to visuals showing people feeling stressed about stock market fluctuations, then showing someone calmly investing using DCA. Alright, now let's get to the big question. Can dollar cost averaging really make you rich? Well, it depends on a few things. The time horizon DCA works best when you have a long-term investment strategy. Over time, markets tend to go up, but they also go down. By consistently investing, you benefit from the overall market trend, and history shows that stock markets tend to grow over the long haul. But short-term, it could be more volatile. The asset you invest in DCA doesn't guarantee you'll get rich. It all depends on the asset you're investing in. If you're investing in a solid growth stock or index fund, you may see significant returns. But if you're investing in a stagnant or declining asset, your results won't be as impressive. How much you invest simply putting a small amount of money in once a month for years won't necessarily make you a millionaire. The magic of DCA comes when you consistently invest larger amounts over a long period of time. Cut to graph showing the impact of consistent DCA with different monthly amounts. Here's an example. Let's say you start with $500 per month and get an average return of 7% over 30 years. That could turn into over $500,000. But if you only invest $50 per month, you'll end up with much less, even if you stick to the strategy. Let's quickly weigh the pros and cons of dollar cost averaging to get a clear picture. Cut to a split screen showing pros on one side and cons on the other. Pros: reduces the impact of market volatility, helps avoid emotional investing, easy to automate for regular investments, works well in a long-term, growth-focused strategy. Host. Now, the cons. It might not perform as well as lump sum investing, especially if the market is on an upward trend. You could miss out on big gains if you don't invest all your money up front. It's more of a strategy for patience. You're not going to get rich overnight. Now let's take a look at some real-life scenarios to help you better understand the impact of dollar cost averaging. Let's say you're investing in an index fund like the S&P 500, which has historically given average returns of around 7–10% per year. Cut to visuals showing long-term S&P 500 performance. Over time, consistent investments using DCA could give you solid returns. But remember, if you'd invested all your money at once, say in 2009 when the market was down, you would have seen much higher returns by 2025, since the market bounced back strongly after the recession. But, the beauty of DCA is that you don't have to time that market. You simply keep investing, and you take advantage of both the highs and the lows. So, can you get rich with dollar cost averaging? The answer is, possibly. It's a reliable strategy that works best over the long term, with the right mindset and consistent contributions. If you're in it for the long haul, DCA could certainly help you grow your wealth. Just don't expect to get rich overnight. Cut to host smiling. If you're looking for quick profits or trying to time the market, DCA might not be the best strategy for you. But if you're in it for the slow, steady growth, DCA could be the key to building wealth over time. Outro music starts. Thanks for watching. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell so you don't